So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to The Daily Call. Today we are going to be talking about the reliability of stock analyst recommendations. And I know this might actually ruffle some feathers out there. So I will tell you though that before I get into maybe not bashing people, but bashing the industry as a whole, I do think that there are very, very good, smart people in this industry. I don't think that it's full of people who are completely ignorant or dumb. I think the entire industry is full of people who are very smart, very well educated. But I just have one major rub with the whole thing, and that is basically conflict. The conflict of the people who write the recommendations, who basically sell the research, kind of sell-side analysts, and then any conflict that an institution or bank might have with people who buy it. And that's what I've talked about in show 164. So if you go back to the daily podcast right here, and show 164, I talk about my short stint as a research analyst. I was on the side of the Chinese wall, the proverbial Chinese wall, and I basically talked about what I learned there. So you can go back and read or listen to that podcast again. I think the problem with stock analyst recommendations is that it can be anything they want, right? So they do a good job. And the way that I was trained and the way that I was kind of taught, if you will, is that we try to do our best guess, right? I mean, there's nobody who can accurately predict the future. So we all know that. That's not something we're trying to do, but we're trying to do our best guess. And so we talk to the CEO, we talk to the CFO, we talk to, the company, we look at the industry as a whole. What did other similar companies do? How did they grow? There's a lot of research that goes into these reports. I'm not downplaying this by any stretch. I'm actually trying to help you guys understand what goes into it. It's not just somebody's expectation. There's models that are driven and built out and very, very fine data points that we have to look at to say, okay, how much do we expect this industry to grow in this environment? Or if inflation picks up, or if GDP drops. I mean, there's a lot of data points that go into some of these models. The problem with a lot of them is that we can basically set the price to anything that we want it to be. Not that we're going to do that right off the bat or initially, or that anybody was going to do that just for the sake of selling more research. But you can basically set the price on any of these stocks to whatever you want to be just by changing a couple growth levers and cost levers and expectations, right? So maybe you think revenue grows at 1.2% versus 1%. Well, that's not a huge difference, but over time, that could change how the outcome of the stock is priced today. And if it's a buy or a sell recommendation, I mean, it's very, very hard to get accurate representations of where these companies are going to be 10 or 20 years out into the future, right? So one little tweak that you do now to growth today has a compound effect into the future. I think that's, that to me is the hardest part. It's like we have no clue where these companies are going to be. And even more so nowadays with how fast technology is changing, we did a podcast called The Netflix Effect. And basically that any company could be upended tomorrow, right? Like that's the reality of this world that we're in. Look at the entire taxi cab industry upended by Uber, right? Netflix blew out Blockbuster, right? Came out of nowhere, basically. And any of that can happen in a 5 or 10 year span, and maybe even faster now that technology and AI automation is coming up so fast in the marketplace that has to be priced in, and we just can't price that in. We can't realistically say, okay, we think that this company is going to make revenue for the next 10, 15 years with no expectation that they're going to just completely get annihilated and, blown away by some competitor that hasn't even started yet, right? That I think is a really hard thing to get over for most research analysts right now. And what I see is a big drawback to that. The other thing is that for what we do in trading, it's just not that needed. We don't need to reference a research analyst or a stock recommendation or a research report to do anything we need to do in trading. Everything that the market knows, everything that's public information and all expectations of the stock's move is priced into the security right now. Right? Now, it could be overpriced. The market could be overpricing expectations, underpricing expectations, but whatever it is, it's priced in. And when you trade on a short duration or a short timeline like we do, we have the ability to quickly adjust all the time. So rather than what I think of people doing in stock trading is get into a stock position and hope and hold for the next 5 or 10 years that it works out. I want to be able to get into a position and then readjust in the next 30 days and the next 30 days and the next 30 days going forward so that I'm always adjusting to whatever the new market price is. In fact, I don't care where the market price goes for an underlying security. Could go up, could go down, could go sideways. I'll be there constantly selling options and constantly adjusting. So hopefully this concept has been helpful. Like I said, I think, my biggest disputes with stock analyst recommendations are obviously conflict. I think if you look at some of these places that have a conflict where you're selling research and you have clients that are buying that research, totally a conflict there. And I think that the expectation conflict or the expectation problem with just how these models are built and how small changes can really, really tweak the underlying price of a security, I think is a huge disadvantage in this market. So hopefully this helps out. Again, I don't want to totally bash, I'm not bashing individuals. I think it's just a really weird old industry that probably needs to be reformed at some point, but people like reading research and I get that. And that's why it's still around. So hopefully this helps out. Until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.